Digital lending in Kenya is fast becoming a key lifeline. According to a study on the impact of digital lending, 65% of the adult population in Kenya do not have a bank account, while 45% of borrowers on digital platforms lack a formal credit rating, even as 87% continue to struggle with access to credit, having never had approved loans for above 3,231 shillings or $25. The study by Professor Omri Eventov of the Haas School of Business, the University of California, has found that mobile-based lending in Kenya is improving financial well-being for underserved borrowers, but introducing new risks such as over-indebtedness owing to lack of financial knowledge. The research shows that financial health improved significantly for underscored borrowers with no credit history, who benefited the most from mobile lending service as an entry point to formal financial systems.
Another cross-sectional test that we look at is basically, why did you take the loan? Okay, so there's evidence in research that people who take loans for productive purposes usually benefit more. And it kind of makes sense, right? If you take the money for business purpose, you're more likely to generate income out of it rather than if you're taking for personal expense that is not generating income.
As we have this conversation, core is actually data. We need to actually continuously recognize the power of data and how actually mobile data can objectively be used for understanding financial well-being, especially for people who don't have substantive formal financial records. And I think the second bit for us becomes just the value of credit in itself. We've talked a lot about access, but we don't talk enough about the impact. And just to share a bit more, two things that really stood out for me. We saw customers actually self-reporting that their income had increased by